Welcome, dear traders. You are watching a recap of the Asian session on September 6. As a rule, Asia-Pacific exchanges start trading based on yesterday's sentiment in Europe and the United States. And today, the Japanese and antibody stock indexes reflect the previous day's close on Wall Street, considering domestic data. On Tuesday, major U.S. indexes closed lower amid oil prices soaring to a new 10-month high after Saudi Arabia and Russia extended the supply cuts until the end of the year. Importing countries were threatened with renewed inflationary pressures. Moreover, the current oil market deficit is likely to increase. As a result, global economic uncertainty is increasing. The stock markets have gone into a wait-and-see mode, and the risk appetite has declined. The situation is different for the U.S. since the country has its own oil resources. U.S. economic statistics indicate that the economy is stable and may avoid recession. Member of the Federal Reserve Board of Governors Christopher Waller touched upon this in his speech yesterday. Data is looking good for soft landing scenario, the policymaker said. However, Waller added that it would be better to keep higher interest rates for a longer period. Federal Reserve Bank of Cleveland President Loretta Mester also maintains a hawkish stance. This week, several more Fed representatives will announce their decision on the interest rates. In general, markets expect the Fed to take a pause in September. At the same time, the odds of a quarter-point hike are still 40% for November and 37% for December. US dollar bulls benefited from yesterday's hawkish comments and the risk-averse market. As a result, the greenback surged overnight to a new 10-month high. Yields on US government bonds also rose. Thus, the 10-year Treasury yield exceeded 4.2%. It widened the interest rate differential for the US dollar. US economic news also supported the national currency. Tuesday's reports on the factory orders showed the largest drop in 8 months. Nevertheless, the figure was still above forecast, strengthening the greenback. Meanwhile, the US dollar's sharp rally was limited by Christopher Waller's comments. He said that we can just sit and wait for the data, given a bearish signal for the US currency. As a result, its US dollar index started Wednesday with a high volatility on the downside within the range of 104.60 and 104.90. The US dollar was moving close to its highest level since March 15, around 104.80, trading near 105.70 early Wednesday. The US dollar was also boosted by weaker than expected economic news from China. Property developer Country Garden managed to avoid default, and the problems in China's real estate sector have been tackled. Today, China's stocks rallied on hopes that the authorities would stimulate the real estate market. However, the services activity index fell to 51.8% in August. In addition to the economic concerns this week, there were also worrying sentiments on the China-US relations. Apparently, US Secretary of Commerce Gina Raimondo's recent visit to Beijing was not as successful as expected. In addition, ongoing trade tensions between the United States and China are reducing investors' appetite for risk assets. While stock indexes in Australia and in New Zealand were following China, Japan's Nikkei rose for the 8th consecutive session. The weakening yen improved Japanese companies' export prospects and made domestic assets more attractive. The dollar-yen pair hit 148.80 in the early trading on Wednesday, its highest level since November last year. After that, Japanese officials, Deputy Finance Minister for Economic Affairs Masato Kanda and Bank of Japan Policy Board member Hajime Takata stepped in. However, their comments did not provide any new information. If the speculative moves continue, we will not rule out any options, the officials said. In fact, it does not matter so much what the Bank of Japan is warning about. The regulator is signaling that it's closely watching the national currencies movement. Masato Kanda spoke to reporters after the dollar-yen pair approached the level of 148 overnight. It's the strongest level in a trading history. This was the strongest warning since mid-August. At that time, the Japanese currency pierced the key level of 145. Since then, the authorities have stopped opening short positions, forcing traders to wait for a possible intervention in the forex market. Today, the greenback strengthened against its counterparts amid the prospects of a rate hike by the US Central Bank. Meanwhile, the Bank of Japan is likely to continue its out-or-lose monetary policy. In this way, the Japanese regulator intends to stimulate demand-pull inflation caused by strong wage growth. The yen's weakness against the US dollar is due to the regulator's different approaches to their monetary policies. On Tuesday, economic news in Japan whined on the yen after Japanese household spending dropped more than expected. However, investors seem to have heard the warnings from the Japanese authorities before the yen sell-off, or perhaps they priced in the events that may occur later in the European and the US sessions. Nevertheless, the dollar-yen pair consolidated near 147.40 in the Asian trade after a slight drop and traded within the range of 147.00 and 147.80. Today, there are both bullish and bearish signs for the Australian dollar. The surge in oil prices is the first one. As a commodity currency, the Aussie seems to have taken full advantage, and today its price began to rise after dropping to the support level of 0.6360. The Aussie bounced from its lowest level since last November. During the Asian session, the Australian currency managed to climb above 0.6400, supported by strong domestic data. And the data showed that the Australian economy expanded more than expected in the second quarter. However, the economic downturn in China, along with the risk of sentiment in the global markets and the strengthening of the US dollar, put pressure on the Australian currency. As a result, the Aussie dollar pair moderately rose in the range of 0.6357 and 0.6405. However, technical indicators suggest that the pair may remain bearish in the short term. Today, the New Zealand dollar also dropped to a 10-month low. After testing 0.5860, the Kiwi began to rise moderately and even climbed to the resistance level of 0.5900 in the early Wednesday trading. However, bears managed to take control of the market again. The Kiwi dollar pair was moving within the range of 0.5860 and 0.5905. Although it kept showing green figures, it's a bullish momentum weekend. And that's all for now. Leave your comments down below and don't miss our next video review. Remember that staying up to date is the key to success in your trading. Subscribe to the channel and see you online soon.